Jaltech is offering South African investors the opportunity to take advantage of the energy supply crisis in South Africa and to gain exposure to an asset class which provides long-term predictable yields and the tax benefits available to South African taxpayers. Jaltech is an alternative investment fund manager. We manage over 2 billion rand, and our business is supported by more than 1,700 investors. In the last year, we financed more than 27 megawatts of solar installations, investing approximately 365 million rand to do so. Our current solar portfolio is made up of 159 solar assets. As South Africa's fastest growing solar fund management business, our team is made up of business developers, fund managers, and attorneys, all of whom have a sole focus on Section 12B and solar financing. The last financial year saw our team invest in over 27 megawatts of solar installations, into which we deployed 365 million rand. A key deliverable under Section 12B is capital deployment. We're delighted to share that in the last financial year, we deployed 93% of capital raised. Drilling down into the makeup of the current solar portfolio, investors will note that the various solar assets are installed across South Africa, and the solar equipment is generating power for businesses across a number of different sectors. We'll now break down Jaltech's latest Section 12B investment, which will qualify investors for a tax deduction in the 2025 financial year. Section 12B was introduced in 2016. The 100% tax deduction was enhanced in March 2023 to 125%. The 125% tax deduction for investments into new solar assets is only available to South African taxpayers for 1 more year. Two key components of Section 12B are that investments must be made into solar equipment and related assets, and the assets must be producing electricity in the year of investment in order to claim the tax deduction. This is an example of how the tax deduction benefits investors. Here we have a person earning 5 million rand per year who has no Section 12B investment. They will pay just over 2 million rand in income tax. Adding the right-hand column, the same person earning 5 million rand invests 1 million rand into Jaltech's Section 12B investment. The 1 million rand investment amounts to a 1.25 million rand tax deduction, thereby reducing their income to 3.75 million rand, saving them 562,500 rand in income tax. In this latest Section 12B investment, investors are de-risked by up to 90% of their initial investment amount in year 1. The fund mandate is as follows. Jaltech will deploy investor capital into long-term solar finance agreements, referred to as power purchase agreements, and our sector focus is purely on commercial and industrial entities. To give investors an idea as to our solar financing value proposition to the market, as modeled on the right-hand side, Jaltech enters into an agreement with a commercial energy consumer, while one of our trusted solar installers and operators installs the solar equipment and maintains it on our behalf during the financing term. We compete with the banks through various differentiators, namely by providing 100% project finance versus the bank's 70% where client equity is required, offering terms of between 10 and 20 years as opposed to the bank's much shorter terms, and by turning deals around in a fraction of the time that banks are capable of. One of the objectives of this investment is to de-risk investors by approximately 90% of their investment amount during the first year of investment. This is achieved through the SARS refund associated with the investment and the first year's income generated. By way of example, if an investor invests 1 million Rand, the investor will be entitled to a SARS refund of 562,000 Rand. This is because the investment is 125% tax deductible. As illustrated, Jaltech will look to raise 500,000 Rand of debt on behalf of the investor. The benefit from an investor's perspective is that the debt funding allows Jaltech to acquire additional solar equipment on the investor's behalf, thereby permitting the investor to claim an additional tax benefit within the same year. As a result of the 500,000 Rand of debt, the investor will be entitled to a second SARS refund of approximately 290,000 Rand. By adding the first tax benefit of 562,000 Rand, the second tax benefit of 290,000 Rand, and the first year's returns, the investor will receive approximately 900,000 Rand during the first year of the investment, thereby de-risking the investor by approximately 90%. Here is a breakdown of the forecasted cash inflows. You will note the two SARS refunds as covered in the previous section. Along with those, the investment returns income to the investor on an annual basis. Important to note is that the cash flows are taxed as income in the hands of the investor. The increased income in year 10 compared to previous years is based on the assumption that the assets are sold at the end of the 10th year. To summarize the returns, an investor in the highest tax brackets investing 1 million Rand is forecasted to receive a pre-tax internal rate of return, including the tax benefits and net of fees of 42%, and a post-tax internal rate of return of 21%. There are additional upside components not included in the cash inflows. Those include wheeling of excess electricity the assets produce, as well as the carbon credits which are owned by investors. As with any investment, there are numerous risks investors need to consider. With this investment, we believe that there are four main risks, namely deployment risk. Investors will only be entitled to claim a tax deduction in the year of investment if the solar projects are producing electricity. In this regard, Jaltech will limit its capital raise to projects which can be executed within the year of investment. The next risk to consider is credit risk. The performance of this investment is dependent on the energy consumer's ability to make regular payments towards their energy consumption. To mitigate this risk, Jaltech will be undertaking an in-depth due diligence and credit check on each energy consumer or project owner, as well as diversify its investments across multiple projects. The third risk to consider is debt financing risk. The investment will look to introduce debts at a ratio of 1 to 2. As a result, and by way of example, should all the underlying investments be repossessed by the debt provider, the investor will stand to lose their original investment value, and the investor may be recouped a portion of the tax savings. Jaltech has mitigated this risk by limiting the debt facility to a maximum ratio of 1 to 2. The final risk is Section 12B risk. The investor's liability within the investment is limited to 125% of their investment value. The remaining liability is held by the general partner in the partnership. The reason why the investor's liability is 125% is that investors must be at risk for 125% of their investment value to claim a 125% tax deduction. Jaltech has introduced various risk mitigations to reduce investors' risks. To summarize the investment, the minimum investment is 500,000 Rand. The investment aims to return 90% of the initial capital investors invest back in year one. The investment is asset-backed and the assets will be fully insured. Investors are exited gradually through the annual distributions they receive. The internal rate of return, post-tax, net of fees, and including the tax benefit, is 21%. The 125% tax deduction is enhanced due to the debt raise to 187%. There is a fundraising cap, which is in line with the deployment expectations of the fund, and investors receive income distributed to them annually over the 10-year investment term. Finally, our fees. Jaltech charges an annual management fee of 2.25% and a performance fee of 20% above a hurdle of the investment amount, calculated and charged annually with a high water mark. To explain the performance fee, Jaltech earns a performance fee annually on returns generated above the investment amount, divided by the total average term of the power purchasing agreements signed with end customers. As an example, if the total average power purchasing agreement is 10 years and an investor invests 100 Rand, the annual hurdle would be 10 Rand. Accordingly, if Jaltech returns 12 Rand in year one, Jaltech would charge a fee of 20% on the 2 Rand, 12 Rand less 10 Rand. If in year two, Jaltech returns 5 Rand, no performance fee would be earned. For Jaltech to earn a performance fee in year three, Jaltech would need to return more than 15 Rand.